Hello once again, I'm Richard Fredrickson, and this is Profiles. Welcome to Al's Steakhouse. This is where we do most of our interviews, and we thank Al for accommodating us. And of course, I also make mention of the fact that Sunday brunch and Friday fish, they have the whole thing on Friday. It's kind of a nice buffet on Friday. Always a great place for business lunches, or if it's just the two of you, a nice romantic dinner in the evening hours is fine too, or the entire family. Whatever the occasion or purpose, Al's Steakhouse at Hamus and Jefferson and Joliet. And we thank them for the opportunity to come by, and I thank Howard Ellison for taking time out, busiest time of the year for Wimmer Rogers, Duran and Ruzon. Howard is with us, and we're going to teach you, educate you, inform you, reveal things that maybe you didn't think about for the 2018 tax season, which we are now in, and right in the middle of it. So Howard is here today, Howard Ellison from Wimmer Rogers, Duran and Ruzon, your friendly CPA here today, one of the partners at Wimmer Rogers, Duran and Ruzon, and the busiest time of the year, and he is here for you. We're going to reveal some things that you should have known, maybe remembered, and some new things that you didn't even know existed. So here we go with the tax laws and everything about the 2018 that you should know, okay? And in the very beginning, I'm going to put the number up there on the screen. This is the number you call to get an appointment so that we can straighten things out with your world of taxes. It's 815-730-6250. And if there's something that we may have missed or I didn't cover, just go to wrdr.com. They have most of the most frequently asked questions are there on the website. Okay, very good. Howard, thank you for coming in today. Howard Ellison.
You're welcome, Richard.
Let's start out with, got to put these on so I can see what's happening here. Oh, I know. This is what we said earlier on the radio. Muy importante, very important, and very important. The media is all over the place now telling everyone that, don't expect a lot of, what you got last year on your income tax refunds. And they stopped there. Refunds are not that big, not they promised. And why is that?
And in fact, the media is doing a terrible job. They're focusing on refunds, talking about them being lower than they were last year at this point in the filing season, when they should be focusing on tax, not refunds. Reason refunds are down is because people paid in less. The IRS, due to the new law, the withholding tables were adjusted to adjust for the lower taxes, which means you pay in less, you get more during the year, and if you didn't change that with your employer, you are going to get a smaller refund most likely, but the odds are your taxes are down. We're seeing over 90% of the taxpayers are having a lower tax, okay? Now, some of it's small. It depends on where you're at, what type of taxpayer you are. If you have a business, we're seeing a lot bigger benefit for the small business owners.
And that's what was promised, and we're receiving that. Did you mention to me earlier that this is temporary or kind of a test kind of a situation going on here?
Yeah, this is
going to go on forever?
It's a 6-year law.
Okay.
Sunsets after 2025. So unless it's extended by Congress, an act of Congress to make it permanent, this will actually revert back to our old law. You're going to be looking at tax returns similar to your 2017 return again in 6 years if this isn't made permanent. And it could actually go away sooner, obviously, as well as later.
So let's do this again. Let's compare the 2017 and 2018.
Correct. We need to compare your returns. Unfortunately, it's going to be a little more difficult this year because the tax form was drastically changed. They kind of made it so that they could sort of tell you that you could do a postcard. Remember, everyone promised the postcard tax return. Well, so now you've got a 2-page return with each page half a page, but then there's all these subschedules and everything. So very few people are going to be just on those 2 half pages, which would be your theoretical postcard, I guess. But it doesn't look anything like the old tax returns. But luckily, if you use a preparer or if you're preparing your own, most tax software does have what they call a 2-year comparison. So you want to make sure you're looking at that and you're looking at your tax after credits year to year. And if your income is similar, odds are, the odds are great that your taxes are lower. Your refund might be lower, but then you need to look at what did I pay in, and you're going to see you probably paid in less as well.
Yeah, so you made more money.
Yeah. So overall, yes, you made more money.
So if you want a bigger refund, what do you do?
If you want a bigger refund, now you say, okay, wait, I really want that extra $1,000 that I used to get. Then you need to go into your employer and you need to change your withholding form. So you need to either reduce the number of dependents that you're claiming, or if you're claiming married now, maybe you change it to married but withhold at a single rate. And that'll get you more withholding. It'll lower your paycheck, your net paycheck during the year, but you'll get that bigger refund if that's something you rely on. A lot of people can't save. They
Right.
they have difficulty saving, and that's their way of having a forced savings.
Yeah.
So they can take that vacation or whatever big purchase they might want to have.
Not a great idea, but it is an idea shared by a lot of people who say, well, yeah, I like that refund in May or March or June, whenever it shows up.
Well, usually it's pretty quick.
Yeah.
It's-
But
yeah.
everything that was set up is happening. And we're getting more money in your paycheck and a little less in your refunds. But businesses out there, by the way, if you're watching, and if you didn't listen to last week, we were on WJOL about a whole stream of ideas here and cautions on new tax laws. But the businesses need to watch this, and if you have a small business, particularly, you need to take a look at your entertainment expenses and a whole list of other things in charitable giving. So let's start with that.
Okay, so under the new law, entertainment is no longer deductible. But meals, for the most part, are still 50% deductible. So you got to be careful. Don't lump your meals and entertainment together. Your tax preparer is not going to know what is or isn't deductible. Things like sports tickets, golfing with your clients, that's no longer deductible. Okay, so that's entertaining your client. But the meals associated with it, as long as there's a business purpose to either entertaining them or before or after the entertainment, that meal portion is still 50% deductible. So, if you're keeping using QuickBooks or something, make sure you're separating meals from entertainment. We used to lump them together. Can't do that anymore. You have to add another account. Make sure you're separating your meals and entertainment. A lot of people are kind of getting surprised. It's like they forgot that we told them, and
It's all your fault.
they bring their records in, and then we're like, wait, we need a breakout of the meals and entertainment. So make sure you're breaking that out. Don't even, you should still track your entertainment. It's good to know what you're spending on that. As a business person, you want to know what you're spending, and so that you can determine if it's still benefiting you.
If you are an employee now, and you're traveling and you're turning in expense things and whatever the situation may be, that's a little different now as well.
Right, and again, people are shocked again. So apparently they don't pay attention to the media, et cetera. This was big news. Miscellaneous deductions also are no longer deductible. That's things like your unreimbursed expenses that you as an employee. Okay, remember, if you're a small business owner, you're still getting your expenses, but employees can no longer deduct any of their unreimbursed expenses. That's your tax preparation fee, your brokerage fees for your investments. None of that's deductible anymore. It used to be deductible as a miscellaneous deduction, subject to 2% of your income. So people are they're like, wait, what do you mean I can't deduct that anymore? And I'm like, well, we told you last year. We're trying to remind everyone, if that's still the case, talk to your employer, okay, and maybe work out an arrangement to get reimbursed by the employer. If it's an accountable plan, it's tax-free. The reimbursements, you're not going to get taxed on it. But right now, you're losing all that money with no tax benefit even. So try to get reimbursed by your employer. The employer still gets to deduct it as an expense, subject to any rules. If it's entertainment, things like that, they may not be able to. The meals only partially. But at least you can work something out. Maybe take a smaller raise. as a trade-off to getting reimbursed. You can probably, it's pretty easy to figure out what am I losing here versus what am I gaining. So if you have $10,000 in unreimbursed expenses, maybe you take a couple thousand less in raise, you're still going to get your 10 grand back. You're obviously better off.
You hear that? Once again, I'm talking to Howard Ellison, a partner at Werner Rogers, Duran and Ruzon, and I invited him here in the midst of just craziness of taking care of everybody's taxes, both individuals and companies and corporations, et cetera. One of the things that we had mentioned earlier on the radio side was the fact that in the day, you and I would use our equity in our home, our primary residence, to do all kinds of stuff. And that all kinds of stuff has kind of gone away.
That's right. You can't use your home anymore as a bank account to pay off your credit cards, buy a new car, things like that. So under the new rules, any loan that you take out on your home has to be for acquisition or improvements. Okay, and you got to be real careful if you're thinking about maybe building a vacation home or something. You can't use your primary residence to secure that loan because it has to be tied to the property that you're buying or improving. So you got to make sure any new loan, if you're going to build something, you want that to secure, that new property needs to be securing that loan, not your primary residence, because you're not going to be able to deduct the interest. And
I talked to you earlier about does it have a positive or negative impact on that kind of purchases? And
I think for the most part, I don't think so. I mean, because most if it's a pre-built condo or whatever, you're probably going to use that as the primary security anyway. Building it, maybe you're going to lose a little interest, like on a bridge loan or something. But if it's secured by that property, even a bridge loan properly written could still potentially be deductible. So just be careful. Make sure when you're doing all this, make sure maybe talk to your tax advisor before you do it. Don't jump in and then after the fact ask what the tax ramifications are.
Because after the fact doesn't work real well with the IRS. It just doesn't seem to work real well. Planning ahead, by the way, we talked about the higher standard deductions. That many of us will no longer get that extra little pop in our tax benefit for donations.
Donations, yeah. Well, and that's actually, one thing we didn't touch on. It's in conjunction with not only the higher standard deduction, but we also have the limit on what we can deduct for state and local taxes, which includes our real estate taxes. So basically, that's limited to $10,000. So especially people as they get older, they have very little mortgage interest. So now you've only got $10,000 there, and even if you're given $10,000 in charity, that's $20,000. But if you're married, your new standard deduction is $24,000, which is almost twice what it used to be. So you're obviously going to take the free deduction, which is the standard deduction, instead of the $20,000.
Yeah.
So, because remember, that's a free deduction. And if you're over 65, it's even higher than $24,000. But there are planning tools you can use where if you still want to try to get a tax benefit out of your charity, remember charity primarily should be to help people, not a tax vehicle. Yeah. Okay, but if you still want to get something out of your charity, there's ways to do both. Nothing wrong with that. Things like bunching your donations into 1 year, to bunch maybe 3 or 4 years of donations if you have the cash flow. Some of the big brokerage firms have what they call donor advised funds, and what they can do is usually there's a limit of you have to put at least $5,000 in, but you put the money into this donor advised fund, you get the deduction now, and you can have them spread that money out to the charities of your choice over 3 or 4 years. So now you've gotten over that $24,000 hump in 1 year. So you take that itemized deduction in year one, and then you get that free deduction of the standard deduction for the next few years while your charities of choice are getting their money annually.
I know that Werner Rogers, Duran and Ruzon does quite a bit of nonprofit. They work with nonprofits and charities, not only in this area, but beyond the Joliet area. Are they aware, are the organizations aware of this? Do they know that when they're out asking for money? Are they telling people?
Well,
this is all-
I don't know what they tell
Yeah.
people. I know that I've done a couple of presentations with jointly with charities, and they should be aware of it because I talked about it.
Right.
So hopefully they're using that as a tool to talk to donors. We've also talked about things like if you have an IRA and you're over 70 and a half, you have to take your required minimum distribution. Well, rather than take after-tax money to give to the charity, you can have the fiduciary you give them a letter of direction, they send the money directly to your charity out of that RMD, the required minimum distribution. Now you don't have to put it in your taxable income, okay? And they get the donation, so really it's no different than getting a deduction. You've reduced your taxable income for that donation, and you're still going to get that full standard deduction. So now you've actually, think of it as adding it to that standard deduction. It's a great little way.
It's key again with all the things that Howard has talked about. Did you know these things? I mean, if you're still doing your own taxes or your tax preparer, if they're missing these kinds of things, I'm saying this to you: do yourself a favor and go to wrdr.com for more information. And if you want to set up an appointment, talk to one of the partners. You can do so. There's a number right there on the screen at 815-730-6250, locally owned and locally managed, Wormer, Rogers, Duran, and Ruzon. I have a couple more things I want to cover here before we close out. Okay, he's pointing to me. It's a substantial tax break. What is a substantial tax break?
Well, where we're seeing
We
the
like
big,
that, by the way.
yeah,
Yeah.
and where we're seeing some of the biggest tax breaks, which was promised under this new tax bill, is small businesses. It's called the qualified business income deduction. We just call it the small business deduction. Basically, up to 20% of your business income is a deduction, free deduction. So, instead of paying tax on 100% of your business income, theoretically, you might pay tax on 80% of your business income. It doesn't cost you anything. And again, unfortunately, this is part of that 6-year temporary thing. But we're seeing substantial tax savings for our small business owners, which was one of the primary purposes of the new tax bill. Was supposed to be for small businesses. So you got your self-employed, your small S corporations they're called, and your partnerships. We're seeing some big tax savings for them, and also rental real estate if they have property, that generates income.
So they have 6 years to campaign, to get together, to work on, to talk to their Congress people, to make sure this thing
To try to get it
continues
get it
on.
made permanent, because if
Yeah.
you may recall back in the early 2000s we had a similar issue with a tax bill that was sunset after 10 years, and even though parts of it did, thanks to lobbying, a good chunk of that tax bill did become permanent.
Yeah.
And so it can happen again.
That's good news. Now here was some more expiring news. Something called extender.
Tax extenders.
Tax
Which we've had over and over the last decade. Okay, so I think part of the problem with this was that due to the budget fight, this got pushed to the side when the government shut down. There were several provisions in the tax code that expired at the end of 2017, such as deduction for private mortgage insurance, the individual residential energy credits. There's some other credits also that expired, and they were originally going to be in the original budget, but due to the shutdown and everything and the renegotiation, they got tossed out. So they expired, but there's pending legislation out there. Senator Grassley actually submitted the bill, I believe, February 28th. So if you have substantial private mortgage insurance or you did some improvements that might be eligible for those energy credits, you're in a bit of a dilemma, because you can either file your return and forego those benefits, in which case you might have to amend your return later if you want to take advantage of them, but that will cost you money unless you do it yourself. Or you could wait and see. And I'm thinking, at first I was hoping that by this week we would know. See if this has any legs. I would think by mid-March we'll know if it has any legs. The downside to this, and the reason they may not do it, is simply because the filing season is so far along.
Yeah.
And so that might have lost steam due to that.
And the airing of this program will be right at that time.
Yeah, so,
right
you know,
week.
so check your, make sure you're
Yeah.
Googling tax extender. You might be able to find out what the status is of that.
And here's something that you mentioned every single year, and we'll do it again, and that is conventional and Roth IRA contributions for last year can be made all the way up to.
Up till April 15th. So, there is, even though if you missed out on your tax planning during the year, there are certain things you can still do. If you're an individual, again, the IRA, deductible portion, the Roth, you can still do, but that's not going to impact your taxes, obviously. But if you're a small business, you can actually do, if you have a profit sharing plan in place, you can even defer payment of that all the way to the extended due date of your return, and take advantage of that. File your return now, and you'll have till September or October, depending on what type of business you are, to actually make that contribution.
Yeah. So contributions to, as a business, small businesses now, for 401ks. And
Simple IRAs, SEP IRAs, all those types of things.
Okay.
Most of the plans had to be in place in 18, but you can actually set up a SEP plan after the fact, now, and still take advantage of that.
And other things that small businesses can take advantage of is another new rule, changing in accounting to exclude inventory.
Yeah, that's a biggie, and we're taking advantage of that. Yeah, they increased the threshold for small businesses, and so a lot of your small businesses now, if they take it off the books as well, they're getting a write-off for inventory they've been carrying over the years, which should be counted every year, but you're getting a 1-year write-off, and then now you're just going to go on cash basis for your purchases if you're a type of business that has inventory.
I have a
It'll also save you from having to count it every year.
I have a question from Schuster International Enterprises. He's asking about cafeteria plans and flexible spending accounts can make payments and reimbursements
Right.
last year.
Yeah, you can still, make sure you use your money if there's usually a use it or lose it potentially, so make sure you use it. You still had time to use it after the year end. And also, though, if you have a health savings account, for instance, you can still make contributions to that account if you didn't make the maximum amount contributed in 18. And again, that's also a deduction, similar to the IRA rules.
Yeah. So here's a question from me to you. How about my credit cards? The credit card charges that I did back in 2018,
They're deductible in 18. You got to make sure you're giving your accountant that.
okay.
Because we don't know.
You don't know what you don't see.
Unlike Karnak.
Yeah, we'll tell you what Karnak is. Write in and you call him. No, don't.
Yeah, just look up the old Johnny Carson shows. There you go.
Receipts for 2018 charitable contributions of $250 or more must also be received by April 15th.
Correct. Yeah. So if you know you made donations and you haven't received a letter yet from the charitable organization, get on the phone. Make sure you get that acknowledgement of your donation if it was $250 or more. Okay. Because if you're audited and you don't have that, that could be a problem.
Yeah, and if you're a contractor, special services, whatever, and you haven't got your 1099 yet, you need to make that phone call and get to that employer or that business person, make sure they get that 1099 to you.
Well, yes and no. I mean, technically, if you're a small business, you're supposed to track your income. You're not supposed to rely on 1099s. Okay? So,
but make sure you do.
You should be reporting all your income,
Yeah.
not just what's reported on a 1099.
Well, you are such a shining glow of light here. No, actually, there was a lot of good stuff here. That for 2018, now in 2019, why not prepare for 2019? Give him a call and set up an appointment. Howard Ellison and the other partners that are there Irma Rogers, Serrano Ruzon, and do so at that number that's on the screen right now. Thank you for taking time
All right,
out.
thank you.
And we'll see you next time here on Profiles on Channel 6.